just first and foremost, Ken, can you tell us what is the restricted property trust?
Yeah, it's an employee benefit trust. And typically, as Jake alluded to, we've done this in private businesses about 1,000 times, but the public company is a new path to run down. But it's an employee benefit trust that utilizes whole life insurance and creates a current income tax deduction up to 70 cents on the dollar for each contribution.
How is it that we use the restricted property trust, and how is 83B associated with that?
Yeah, so here's the number one bad news. I'll get that out of the way like an Old Testament prophet in terms of restricted property trust. So we have something in here called a 5-year risk of forfeiture. And when we designed this a little over 22 years ago, we were trying to figure out how you restrict property for someone who's in control of their business. And that had not been done before. 90+% of the restricted property in the United States is in the form of stock or stock options. But the truth is you can restrict anything. If I went to work for Jake and Jake said, hey, Ken, I've got this garage behind my office building and it's worth $30,000. If you work for me for 5 years, I'll give you that garage. Well, that would be a plan of restricted property, which would actually give me the right to say, wow, I love working for Jake. I'm going to go ahead and pay taxes on the fair market value of that garage today, even though I'm not guaranteed to get it in the future. So I pick up $30,000 of phantom income tax in the form of an 83B election for you tax folks. And if Jake fires me 2 years later, or I go take another job 4 years later, I am not going to get that garage and I'm not going to get my tax money back. But if I work for Jake for 5 years and a shopping mall goes up across the street to my little garage, so it's now worth $200,000, when he hands me title to that garage, it's a non-taxable transfer. So it almost worked like a Roth IRA until such a time as I would sell it or realize it, then it would be a long-term capital gain, not ordinary income. How about the business has to commit to funding this for no less than 5 years? And if for any reason, bankruptcy, cash flow problems, any reason they go out of business, then we are going to surrender the policy for its cash value and give it to a previously selected and put on notice charity. We're going to forfeit the asset. So that our forfeiture is tied to the 5 years of funding. One of the things, and Jake and I can drill into this later in our discussion, but when we set up a restricted property trust, we can't just do whatever we want. You know, if you guys come with a client and you say, hey, I've got this 50-year-old female, she's making $1 million a year, but she's independently wealthy, so she doesn't need any of her $1 million. We want to put the whole $1 million in here. That would be an enormous death benefit. And my reasonable business purpose for taking that deduction is tied to the amount of the death benefit. I'll give you a terrible example just to highlight that. The very first pro athlete case we did was in the summer of 2015. We've done a bunch since. But the problem with pro athletes is they're young and healthy. Otherwise, they would not be professional athletes. And this particular individual was making between $35 and $40 million a year in endorsements. And his team of advisors wanted him to put $1 million in. He was 25. That was $120 million of death benefit. So if that was ever challenged by the Internal Revenue Service, I would be left holding the bag, saying that I felt it was reasonable that his mom needed $120 million to continue this endorsement company. And I was not willing to put my brand on the line to defend that amount of deduction. So I lowered his death benefit to $15 million.
Who is this for? When does this make sense, Ken? What is the appropriate size and amount? If we go to a restaurant and have a 7-course meal, I mean, what is this on the table?
Yeah, so this is going to be, if you're at a big steakhouse, this is your side of Brussels sprouts. You guys love those steakhouse Brussels sprouts, I do. But this is it. This does not need to be the main course. And it's really going to fit, well, for the first time, it's going to be fit for a public company and their executives as an alternative to their deferred comp. I do want to give this one plug real quickly. In traditional deferred comp, the company is either eating 100% of the tax, they will enjoy a future deduction, at which point in time the executive will pick up 100% of that as ordinary income. Or if the company's not eating the tax, that executive is picking up 100% of that as phantom income today. But either way, there's never any tax efficiencies with deferred compensation. In the restricted property trust, the company's enjoying a 100% deduction today, and the executive is only picking up 30% of that as taxable income. Way more efficient from a tax perspective than traditional deferred compensation. We can do that. And then one other quick thing, just to mention before we tee it up for Jake again, is the big deal about the restricted property trust is that it's fully discriminatory. So when we go in, and I'm meeting with a large doctor group, we've had a ton of success with large medical groups. And the reason we have is because large medical groups can't get on the same page for a sophisticated qualified plan, right? It's really difficult to get 100 doctors to say, okay, let's all do this cash balance pension plan and let's fund it at the appropriate amount when they can't even agree on what kind of toppings to put on a pizza. So with the restricted property trust, we'll just go in and we do the docs one at a time. And we don't have to include any of the nurses, any of the other staff. It's not only discriminatory vertically between owner and receptionist, it's also discriminatory between partners. And that's a big advantage because when we go into those large medical groups, I'm going to have 20% of the folks are retiring in the next 5 years and won't want to look at this. 20% of the folks just got out of medical school and they're paying off bills. And then I'm going to have that middle pack of about 50 to 60% of the doctors that can actually look at this as a strategy.
But they are just an owner operator. And we do a lot of comparisons with defined benefit plans, cash balance plan, and the restricted property trust. Can you kind of go over a few scenarios of when we would choose one or the other?
And one thing I do like to say is I position this in a way, not really, I appreciate Jake said comparison versus competing, right? Because I've got a lot of clients, we probably have several hundred clients with cross-tested cash balance pension plans. And that's great. They have the cash flow where they really need to do both. I think that is less efficient. We can prove it out mathematically in that number one, it's not, it's non-discriminatory in the qualified plan. But then number two, and this is the big one that most people skip over, yes, they're getting 100% deduction today, but they're going to take that income out as 100% ordinary income, every dollar that comes out of that plan in retirement. And I don't know what the tax rate's going to be in the future. That's an unknown future tax risk. Whereas in the restricted property trust, we're generating a 70% net deduction today, but we're going to have access to completely tax-free, non-reportable tax-free income because it's cash value and life insurance. And what you'll tend to see in those comparisons when Jake and I run those spreadsheets is the death benefit is tax-free and always higher than the qualified asset account value. And somewhere around the late 70s, early 80s, because you have to pull almost twice as much money out of the qualified plan to put the same amount in your pocket, the whole life policy is going to have more cash value than the qualified plan, somewhere between 78 and 83, depending on, the policy design and all that sort of thing. So I say to clients all the time, look, the restricted property trust is going to win if you die, because my death benefit's tax-free and always larger. And God forbid you make it to age 83, well, we win then too. If I tell your client they're going to have $1 million in 10 years, the bad news is it's never going to be $1.3 million. But the good news is it's also not going to be $700,000, right? It's going to be probably $1,010,000 or $990,000. It's really that predictable of an asset. And so when you see the volatility that we've seen these last 2 years in the market, whole life insurance becomes an asset like gold. We
have a few comparisons, I guess I wanted to make. A lot of people have heard of like premium financed life insurance. A lot of people have heard of PPLI. A lot of people have heard of a lot of these other things. And the big difference that I wanted to throw out is that, again, this is the Brussels sprouts.
Yep.
And this is deductible going in, rather than like a double executive bonus plan, which again, people are paying taxes and all that money as phantom income now. You're actually able to deduct the money going in as a retirement plan. And because of that risk of forfeiture, they're able to, as we incrementally pay taxes throughout, get it tax-free and have a tax-free death benefit. And so very, very unique distinction, just to answer a few questions that are coming in through the poll. Ken, how do you typically present this plan to somebody new who's seeing it for the first time?
So step one, I'll take your tax risk to zero. Step two is, and yeah, just one more down from that page, Jake. Step two is the 5-year risk of forfeiture is real. So even though you're looking at a 10-year funding, please understand that's 2 separate 5-year commitments. Okay? And then step three is the death benefit. We're putting about $3 million of death benefit on here. That means that your W-2 needs to be about $300,000, or your W-2 and K-1 combined, it needs to be about $600,000, or 1/5 that amount. I can't just do whatever I want. So when this client here is 53, age 54 at the end of the first year, so usually don't run into problems. Where we run into problems with the death benefit is when we've got successful young entrepreneurs. Then what I'm saying is, look, here in restricted property trust, at the end of year 10, you're going to have some taxes on vesting, but we paid those taxes out of the policy, so it's net to net. I lowered the death benefit to help the cash value grow more quickly. I've got a little bit over $1 million, $1,016,000. If you made 8% with no death benefit, you'd have $1,040,000. And then if you can scroll down for me, Jake, let's take a look at these income streams. Yeah, here I can pull $83,000 out every year and pull out, 1.662 million. If you made 8% fixed for 32 years, you would pull out a little bit less. And by the way, if this was a qualified plan, you'd have to pull about 150,000 out to put 83,000 in your pocket.
This is a pretty phenomenal strategy when you just look at it from a tax optimization standpoint. Is it everything that some people want from like a kitchen sink, magic trust, whatever? I mean, it's not that. This is pretty conservative. Every year throughout, we're paying a little bit of tax. And then when the trust is dissolved and the asset of the trust transfers to the individuals, there's a little bit of tax. And all of that is done to maintain this as a bulletproof strategy that is upheld through federal court. And so this is, again, the Brussels sprouts at the dinner table at the steakhouse. And we definitely want to make sure that our assets our clients are working and planning with their assets for the future, for the not only growing them, but also spending them and also distributing them in the most efficient way. And this is one out of many tools that has made a big difference for a lot of our clients.
And I'll even give you a sample case we finished up this morning, but we had a father who is semi-retired. It's a very cash-intensive manufacturing business in the Midwest. And his sons are buying him out. But a portion of the buyout is they're putting $400,000 a year away in the restricted property trust with their dad as insured. And the plan is if he dies, the boys get the death benefit and buy mom out. So she's free and clear. And if he lives, that cash value, when he vests in it, day 1, year 11, goes against the purchase price of the company, and it's done. So it actually, it wasn't the total buyout, but it played a 25 to 30% of the buyout will be through the restricted property trust. So I was able to sell him a restricted property trust. He didn't care about the death benefit at all. He just wanted the deduction and the cash value, and it looked like a good investment. He was diagnosed with pancreatic cancer shortly thereafter. He had a preferred plus non-smoker, and he died 19 months after he had his restricted property trust. And so my trustee cut a check to his son for $16 million, who in turn wrote a check to his two sisters for $8 million apiece. In a sale, which Jake referenced, the number, and you can keep funding it. We've certainly done it that way. But the most common thing is every business owner thinks someone's going to come in and give them $40 million and they sail off in the sunset. What we all know is they're going to get $5 million up front. They're going to get a 3 to 5 year earnout, and then there's going to be a pot of gold at the end of the rainbow, depending on certain metrics, right? That's how businesses get sold. And so we use that earnout to continue funding the restricted property trust. And the purchasing companies love it because it's 100% deductible. Yeah, they're going, can we purchase more of the business this way? And I'm usually going back and telling the client, no, it's a long-term capital gain. Why in the world, take as much money off the table in your long-term capital gain as you can. I don't start worrying about tax deductions until your next dollar is going to get hit at least 40 cents.
Everybody, we have more information on our website, strategictaxsolutions.com. There's an 800 number. You can call. You can speak with Micah. You can speak with myself. We can help coordinate illustrations for you and with Ken's team, of course, for your specific clients if you have questions. Or if there's just a question that you had that wasn't answered here on the call, there just wasn't time because we are up against the hour. Feel free to reach out via email, book an appointment, or just give us a call. And we'll try to help you out the very best we can.